testing. Now, notice that, I should say, in auditing, it's not obvious. In auditing, the time that you're on the audit is actually very precious because a lot of times people have the same year end. For instance, December 31st is a very common year end. Another one is January 31st, which retailers have. So you may have many clients who have that same year end and they all want their audit report done because they have to issue their financial statements. So that time at the end of the year is very precious. So as far as timing of testing of accounts, say, it's possible that you can do some of that testing early. For instance, if they have a December 31st year end, there's no reason why you can't come in November and test the sales from January through October. And then simply, do the testing for, what did I say, October, for November and December, at the end of the year. So you're only testing 2 months in that short time crunch frame where the other, a bulk of it is already done. So when you actually do the testing, a lot of times it's spread out through the year if you can. Now, there are times that you can't. And the times that you can't is when the controls are poor. So let's go back to that. Okay. So some tests can be due before the client's year end. For example, what I just gave you. So, you test January through October, get that done ahead of time. And then simply pick up November, December. So you can go in November when it's not busy and do some of that testing. So this is part of interim testing. Now, interim testing. Interim test. So this would be an example of interim testing. And they generally cannot be used if internal controls are weak. So if the internal controls are very weak, doing the testing in the interim dates is not as effective. And you say, well, why? Because those things that you tested, whatever they were, those could also have an impact on, there could be an impact on it as far as what the year-end amounts are for those accounts, could also be compromised. So, and especially if they do, if they do inventory in shifts, say they do, rotation of the inventory, they have people audit throughout the year. I think I told you most retail stores do that. If you go to Walmart, if you find a 24-hour Walmart, you go in there at midnight, you'll see a bunch of people counting inventory, and they count everything in the store gets counted once a year, but it gets counted in shifts. So this aisle, whatever they are, cookware gets audited and July 14th. All right, July 15th, something else gets audited, men's socks or whatever it is. So a lot of times they'll have the inventory done throughout the year. Now, the problem is if the internal controls are weak, those counts don't really mean anything. So it is possible that you have, these weak internal controls. Year-end numbers are better. They're less convenient, but they're better. So if there is a problem with the internal controls, then you have to rely on year-end. You have to you insist basically on a whole, a full-scale audit. Now, at year-end, a full-scale inventory count. Now, large companies, that's impossible to do, and large companies, though, generally have very good controls over their inventory. So it's usually not a problem that they have poor controls. Okay. So timing, and so I'm going to put this up here under timing. Year-end substantive tests are the best evidence. It's also the hardest to get. It's the most inconvenient to get. So a lot of times, if you can do it, you'll try doing the testing throughout the year. Okay. And now this is one of those things that's kind of I think this is the terminology. Risks, you always want to have them low. Any risk, right? You want it to have it low. The problem is that different clients have different risks associated with them. So when you're actually trying to do the audit, you're looking at detection risk. And the question is, well, who do you give low detection risk to and who do you give high detection risk to? And that's what we're going to talk about now. And it's not always intuitive. Okay, low detection risk. This means that the auditors will test more. So who gets low detection risk? Riskier customers, riskier clients. So maybe you test to the 1% level. So if someone's going bankrupt, they will be given a low detection risk. In other words, you're going to really have to look at everything. A client that's going bankrupt, they have more incentive to cook the books, just to try to stay alive. If we don't cook the books, we're not going to get a bank loan, that sort of thing. So riskier clients get lower detection risk. You're going to hold them to a higher standard. Now, as you might expect, the higher ones are going to be your less risky clients. You got a client that's doing very well, they got all the financing they need, they're not, there's no problems with it. They have a less of an incentive, say, to cook the books. And you're going to actually back off on the testing because they are a lower risk. It would be a waste of time to hold them to a higher standard than really is necessary, given their risk. So higher detection risk. Less substantive tests. So the risk of the auditors failing, maybe they'll say 5% or 10% even. So safer clients, higher detection risk. Riskier clients, low detection risk. You have to look more. For riskier ones. Okay. This next one is a this is kind of a pain. I'm just going to talk about this just briefly. Some companies do their own payroll and they have their own internal controls, and you'll audit their internal controls as to how they do payroll. How do you account for employee numbers and hiring and termination and all this kind of stuff. So when a company may do their own payroll, they may also have somebody else do it. So maybe they have a company called ADP is one of the big ones, that they'll do their payroll for. They say, look, just give us all the information. We'll go through all the payroll, file all the forms, and do all the filing with the IRS and all that. We'll do it for you. Obviously, there's a fee involved, but that they'll do it for you. Okay, so they're taking over that part. Now, just because somebody else is doing it doesn't mean you don't have to figure out what the controls are. So here's a problem. ADP has thousands of customers that they do the payroll for. You cannot have thousands of auditors walking through ADP trying to figure out what their controls are, even though they're required to become familiar with the controls of this service provider. So what they do is they have a service organization report that's put out that everybody uses that as their basis for, okay, these are the internal controls that they have over payroll. So it's another CPA firm that goes in, does this audit of the service provider, and that report is used for, in our purposes, it'll be used for figuring out what the internal controls are over the client's payroll. Okay, and payroll is a common one. For instance, internet services, a lot of times that'll be going through somebody, a different service organization. Selling platforms, Amazon, Walmart, Etsy, or whatever it's called, and all those, they are all service organizations. So when we do our audit, and if they're having something else done off-site, we look at what these reports that are called SOCs, SOC. Take a look at them, see what those are. So, okay. Okay, here's some example of services. The spacing's kind of funny here, but payroll services, ADP, electronic commerce, internet. So these are all, services that a lot of times businesses will use rather than doing it themselves. And again, the problem is for us, the internal controls, where are they? Okay, so there actually are 3 different flavors. And by the way, these are definitely being tested on the CPA exam. It's the only reason why I'm covering them. They've had these in the past, but they've actually what happened is the AICPA actually copyrighted SOC 1, SOC 2, SOC 3. So these AICPA makes the CPA exam. So it would only be logical that they're going to start testing it because they've made these. These are their copyrighted designations. So anyway, these these reports. The first one is a SOC 1, and this is for financial reporting only. This is the one that external auditors will use. This is what CPA firms will use when they audit somebody. But now they test on all of these, but this is what the CPA firm will use. Let's just say the financial audit. Okay, so this is the one that will be used by CPA firms. The SOC 1. And in the past, the CPA exam would only would focus on the SOC 1. They don't do that anymore. They use any of them. Okay, restricted use. This does not go out to the public. Okay, so these are the SOC. This is a SOC 1 report. And again, if say we're having something done by ADP, they're doing our payroll, we will get a SOC 1 from ADP. And everybody that uses ADP will get this report that they can give to their auditors. And it's used by, external auditors use it to get appropriate evidence. Okay, now another thing about the reports is they come in two more flavors. So there's 3 flavors, and then each report has 2 flavors. Lots of flavors here. Type 1 only looks at the design of the controls. Type 2, design and controls, and the operational effectiveness of the controls. Effectiveness of the controls. So type 1, design of the controls. Type 2, design and effectiveness. They actually test to see if the controls are working. Okay, SOC 2, I'm not going to go too much into these last ones here. SOC 2. This is a much more detailed report. So this is the really the most complex of all of them is this one. It's restricted use, and it goes into everything. Hundreds of pages long. Again, there's a type 1 and type 2. But this is a very detailed report, and is usually used by people who are trying to make the decision of, for instance, who to do their payroll. So SOC 2 is a very detailed report. SOC 3. This is for the general public. You can get a SOC 3 report. Unrestricted use. And it comes about because, you know, maybe you're selling something on Amazon. You know, you're selling something on Amazon and you want to know what their controls are. Usually you get a SOC 3 for that, to see what the controls are, how, you know, what do they do for security and all this kind of stuff you can have. I think I had a SOC 1 for Amazon somewhere. Maybe I don't. I got one somewhere. I'll let's see if I can pull it up. But even the SOC3 report though, that's quite a bit. It's probably like 100 pages, something like that. But they kind of go into everything. So anyway, these SOC reports, SOC 1, SOC 2, SOC 3. For auditors, we would generally use the SOC 1 report. The CPA exam, they will test the SOC 1 report, but they're also saying that they're going to test on the SOC 2 and SOC 3. So you do need to know what those are when you take the exam. So the SOC 1 report though is the one, and it's simply there to get evidence of what the controls are over whatever the service is, whether it's payroll or internet or whatever it is. So these reports are because you can't have 1 million people walking through Amazon trying to figure out what their controls are so that they can complete their audit. Instead, Amazon will issue these SOC report, either a SOC 1 or a SOC 3, and that's what they'll use. Okay. Auditing on the internal controls. This is for issuers only. There is a audit on internal controls you can do through the AICPA, but it's different than for the PCAOB. So there's for PCAOB, there's 2 audits, and you can split them up. Can I bold these? Nope, I can't bold those. Highlight them. So you can have 2 completely different audit, or 2 audit reports, I should say. You can also combine them with 2 opinions. So publicly traded companies, they get an audit on their financial statements. They also get an audit on their internal controls. If they do an audit on the internal controls, they also have to do the financial audit. It's kind of a weird thing, but a company can get a financial audit and not have an audit of internal control. However, if they get an audit of internal control, they have to have that same firm at the same time do a financial audit. So basically, you're required to have them both done at the same time. And the idea is, unless you're doing a financial audit, you wouldn't know what the problems were in the internal controls. So those 2 are generally done at the same time. Truthfully, the logistics of it are that the internal control audit has to be done with a financial audit. You could have an extra financial audit that was done without doing the internal controls. I don't know why you would, but if you just had money to blow on something, I guess. Okay. So 4 things that must be met for the internal control. Management accepts responsibility. Management must evaluate the effectiveness of the internal control. They must support their assertions of what evidence did they have. And management will make a written assertion about the effectiveness of the internal controls. Now, this is what the auditors audit. So notice that it's kind of a strange situation, a little, well, it's not really this, but it's so auditors will give an opinion on management's written assertion. So what we do is management has their written down, here's our internal controls. This is how we understand them. This is the evidence that we have for doing it. The auditors will go in and audit that assertion. And the opinion is not truthfully on the internal controls. The audit is on that management assertion. So it's sort of, it sort of separates the auditors from management could claim that they didn't know, or that they, whatever. So when management writes it down, this is management taking responsibility for it. And then you go and kind of like the financial statements, and then you go in and audit that, their assertions. So management documents their internal controls, and they have to have evidence and all that kind of stuff. The auditors come in and audit to that management assertion, whatever it is, whatever they came up with. Okay. Indicators of material weakness in internal control. These are some, fraud is obviously one of those things that indicates internal control problem. Restatement of financial statements, obviously. During the financial audit, material misstatement. So if you find a material misstatement, and this is why we do it, they do them together. Come on. Ineffective oversight, basically that the board of directors are not doing their job. Okay, so what happens when you find an internal control weakness? To be communicated in writing by the report release date. For government entities, only written communication must occur within 60 days of the report release date. They'll test you. They can test you on this on the CPA exam, probably not as often, but you may wonder why that is. When you do governmental audits, they require that you report all fraud that you find. Excuse me. So even if it's not material, you report all fraud. So a lot of times, the fraud reports possible, they could be huge. And getting those together, you don't want to hold up the release date of the report, but you're generally required to report all fraud that is found to the government. Lesser deficiencies. In other words, things that are insignificant, or insignificant, let's say. Should be communicated in writing to management. Within 60 days of release date. So, and these are only for issuers. Material weaknesses and significant deficiencies, you have, those have to be given by the release date. Lesser deficiencies, things that are insignificant, should be 60-day report date, and should inform those in charge of the governance of that communication. You do not just, that's a picky point there. You simply have to inform the people in charge of government that you've given this written report to management. You don't have to give them the report. Now, they may ask for it, and if they do, obviously, you tell management they need to give it to them. But the idea is that these things are insignificant, And generally, you don't want to bother the board of directors with things that are insignificant for a couple of reasons. You don't want to waste their time, A, and B, you don't want them looking at something that's insignificant and thinking that it is significant. So if you give them 5 things, they might look at those and say, oh, wow, these are all bad. The problem being that maybe only the first one needs attention, and maybe they're focusing on number 4. Because you remember, a lot of people are not experts on internal control, even board of directors. So you only want to give them those things that are important. Here's the important things. Oh, by the way, those things that aren't important, we gave a list of those to management. So you can talk to management about getting those. Okay. Yes. I'm so sorry. This is pretty dry stuff. This is one that gets tested more than you would think. Communicating absences of deficiencies. You cannot issue a report or make a statement that no material weaknesses were identified. And there's a good reason for that. People might think that there's absolutely no problem with internal. And remember, the weaknesses, well, first of all, auditing, we have reasonable assurance. So even though we were looking for things that are material or significant, we may not have found them. You cannot issue a report saying that there are no material or significant weaknesses. The client may want you to. Did you find, well, you didn't find any, right? Well, can you just put that down? Can you just write down that you didn't find? No, you can't, because people might rely on that, and there could be a significant or material weakness out there. So you cannot give a statement saying that there are not any material weaknesses or significant weaknesses. Okay, let me see how much. This is the last. This has to be the last thing, right? Boy, all right. Committee on sponsoring organizations. CASO. CASO stuff is getting more complex every single year. And here are what it is. What it is you have all these different organizations, and they all had their definitions of what was internal control. So you had all these different financial organizations, and they all had a different take on what was internal control. What was the definition of it? All right. So what they did is they all got together and said, let's make a comprehensive definition of it. And every year this gets more and more complex, and on the CPA exam they test it. One of the participants obviously is the AICPA. They make up the CPA exam. So that's one of the reasons why this gets heavy testing. Okay, so there's 5 components to it. I'm not going to go too far into these, but these are the 5 components to it. The environment, risk process, controls, communication, and monitoring, kind of a loop that goes back to the whole thing. And we are not going to go into too many of these. Control activities. This is something that gets test on the CPA exam. You remember it by PIPs. And there's also the new one is authorizations are in here too, but performance reviews, we talked about those. Informal information processing, physical controls, keeping things locked up, and segregation of duties, which is obviously the big one for us. Okay. Now, the objectives. And this is a little bit funny. I don't know why I put think here, but think. You'll notice that these are the different types of audits we have. This is an operational audit. This is a financial audit. This is a compliance audit. So these are actually, these three different objectives are actually really just the type of audits that we have. Operational audit, financial audit, and compliance audits. Okay, so not only do we have these 5 categories, these 3 different objectives, but also we have different levels of the organization that have different levels of internal controls. So for instance, entity level, the entire entity, think like General Motors division, you know, they probably have financing and trucks and all this other stuff, but they probably have one for auto manufacturing unit, it would be Buick. And the functional level is you're making Buicks in the assembly plant in Wisconsin. Okay, so you also have within an organization the different levels. So you have 5 items in the framework. So this is the cube, by the way. Hard time getting the cube on the screen here, but this is the cube. So you see our 5 different, our framework, 4 different levels, and 3 different objectives. And that's what the CASO is. Again, this is one of those things you're going to study like mad when you get to the CPA exam. But we will call it a day for this. Is that right? Yes, it's the end. Okay. Okay, so what I'm going to do next, I'm going to send out the multiple choice questions for chapter 7. And oops, not that. Okay, 1 second. Okay, and then I'm going to put the poll up. Extra credit points will be given based on the poll. Mhm. Go ahead and share my screen. You should get this in a second. Okay, I think you should get it. Okay, so take your time to do this. We'll come back at say, I don't know, 7:05 maybe. And see if you can get it in by that time. So whether you do it now or take a break, come back. Oops. Okay, well, it looks like everybody turned them in, so. Okay, first one, B is correct. No, looks like somebody picked A. Wait, I didn't, hold on a second, let me share these. There we go. The audit committee doesn't do the assessment. The management does the assessment. So this annual reassessing control risk, this is done by management, not the audit committee. Okay, second one. Which of the following is likely to extend the substantive testing procedures? The first one, someone picked that they hadn't, but in the accordance to the audit plan, they were decided not to do test controls. So this one, they decided not to do test controls. D is correct. You guys got it. C. Should not be assigned to the accounting department. Yes, this is custody of assets. We do record keeping. Oh, wow, 4 is a split. Which would be a least considered benefit of internal control? There's one on here that is impossible. You are never going to eliminate all employee fraud. You might reduce it, but eliminating all employee fraud, think about someplace like Walmart. How are you going to keep someone from stealing a candy bar on their break or something? It's okay. Let's go to this one. Yes, this one is correct. Good. C isn't bad. A couple things there. You do not report those to regulatory agencies. And second of all, you do communicate with the audit committee, but only for those things that are material or significant. Okay, let's go to 6. Yeah. Bonding is like an insurance policy. And they basically will not insure a company, an employee, if they have a dubious background. In the consideration of internal control, operating effectiveness. So this is not an understanding. This is operating effectiveness. And that is tested by test the controls. Okay. A well-designed internal controls functioning, likely to detect arising from an individual employee. If people are doing duties that are not shown in the organizational chart, it's very hard to find that. And same thing with management fraud, because they're management, they can override controls. So the internal controls won't matter if management overrides them. But if it's one individual, a lot of times it can be caught. Right? Who picked E? There is no E. But there is a B, and B is the right one. Another E. Who is picking E? There's no E here. This one I'm pretty sure is going to be A. This is kind of wonky the way it's worded. This is going to be the opinion on the financial statement. So there's opinion on the management's assessment and then their own opinion. Okay. Well, that's not bad. Save that. Okay. All right. End of the audit procedures. So what we're going to talk about for chapter 16 is about that. Oopsie daisy. He's not paying attention here. So chapter 16 and 17. Chapter 16, we're only doing the second half of chapter 16, which is the wrapping up an audit. And the reason we're doing it is because wrapping up the audit a lot of times flows into the actual writing of the reports, which we'll get to next week. So we're just going to talk a little bit about wrapping up the audit and what kind of the procedures you do to wrap up the audit. And one of the big things you do is you get a management letter. Management has told you all these things throughout the audit. You know, how did you come up with this? How did you come up with that? Where did this number come from? Well, why did you do this transaction? All this kind of stuff. And so all these things that you relied on, you know, are going to be, you're going to put those into what they call a management letter, and management signs that management letter. It's signed by the CFO, Chief Financial Officer, and the CEO, Chief Executive Officer. They both sign off on the management letter. If they don't sign off, it's a big problem. because it indicates that there's something in those that you've relied upon that you can't. And then also when somebody doesn't sign it, it's an indication that there might be something wrong. And the next obvious question is, why can't you sign it? So the management letter is a very important letter. It does not replace your audit evidence. It's not considered a evidence by itself. But what it is it reaffirms the stuff that you relied upon. And if they don't sign it again, it indicates that there's something else wrong that is not being told to you. And you can issue a disclaimer if you're not given a valid reason as to why they can't sign it and they're not signing. So, okay, management, and we're not going to go through all these, but basically you go through and say, you know, do we have everything? How about this? What about that? You know, all these things that you are, all related parties disclose, all liabilities. And you can read through these. There's quite a few in here, but basically all those things that you rely on, you're going to ask them. Okay, problem one. The CFO, they give the management letter. CFO refuses to sign and states that I was only hired in October 10th of this year, and I'm not responsible for the entire year. What options do you have? So the CFO says they can't sign the letter. Excuse me. Anyone? You can put it in chat if you want. So chief financial officer won't sign it. And I'll tell you something, there's actually two of them on here that you can do, according to the AICPA. Anyone? Oh, come on. Are you guys sleeping? You're sleeping, aren't you? Love your class, Mr. Taylor. You just can't sleep like that. You know. All right. I'll split it up. You had the choice that the AICPA will give you is this one, give a disclaimer, a more severe one to be withdrawn from the engagement. And usually if you threaten one of those two, say, look, if you don't sign it, we're going to give you a disclaimer, or we're going to draw from the, in other words, we're going to walk away with nothing. You're going to have nothing. Usually they'll say, okay, I'll sign the thing, or tell why they can't. You know, this, that I was only hired on October 10th. This stuff that's in there, you'll notice that these are generally for year-end things. So, and especially if they've already been on the job for a couple of months, they should at least have some idea of it. Okay. Subsequent event, type 1. Type 1, I think I'll write this. Events that existed at the balance sheet date. Type 2 event. Events that did not exist at the balance sheet date. And so, okay, so events that exist at the balance sheet. Let's go through here and see what ones we have. Let me go. Let me tell you what we're looking at here. Okay, now I do want to change the camera. So it's kind of like this. Okay. So here's their year end 12/31. And let's say that the audit will do field work. Will go until February 7th. And then about a week later, they will issue the report. Okay. Subsequent events are events that happen between these two. And there are things that happen, and it's possible that they were already on the books over here, and now we just have more information. Could also be something completely new that happened. So it would be type 2. So if the subsequent event, if they existed at year end, type 1. If they did not exist at year end, they're type 2. Now, type 2 are for big events. And usually a large change in financial structure. It's hard to read. Large change in financial structure. Things like mergers, things like divestitures, selling off a large part of your business. Things like if you have catastrophic events, one of your assembly plants blows up and will not be used for another year or something. So these are type 2 are really only for big things. It's not for everyday little things. These could be kind of little things. So for instance, you have a lawsuit and you have it on the books here on 12/31, what you put that you might gonna lose $12,000, whatever, and the lawsuit gets settled. That would be a type 1. It existed at year end, but if it was settled on 1/21, it would relate to that. So whatever the lawsuit was settled for, you go, okay, well, that, if we settle it for 21,000, then that should be 21,000. The liability should be 21,000 at 12/31. Type 2 events are big things, and they generally have to change the nature of the business. Oops. They have to change the nature of the business. And what you're going to do, what you're really telling the people, the readers are, look, this company is different than it was in last year's financial statements. Maybe they sold off half their business. Let's say they make shoes and socks. Let's say they got a big offer and they sold out the sock business. You got to tell the readers, look, don't be expecting any income or revenues from socks next year because it's not there. Financial statements have this kind of predictive value that people read them and say, okay, then what's going to happen in the next year? Because they're kind of, even though the financial statements themselves are historical usually, they also have this predictive value. Okay, if sales went up by 3% last year, then probably they go up by 3% this year, that kind of a thing. But you tell the reader, look, the company's half as big or twice as big. We merged with somebody else and now we're twice as big. Okay. Client announced a merger with a large competitor on January 27th. Yep. Yeah, you're going to tell the reader, look, this company's twice as big now, or however big it is. You're going to say, look at, and so this would be a type 2 event. That it's large. It's not the same company it was. It's not the same company. It's going to be the financial statements you'll be looking at. Client had a lawsuit that was estimated at a loss of $40,000 on 12/31. On February 12th, 2022, the case was settled for $36,000. So what is that? I think I just gave that as an example, didn't I? Let's see, that's a lawsuit settled. Yep. So this would be a type 1. It existed at year end. Now we just have more information. So if they had it on the books at 40,000, you can say, okay, you can put that in the books at 36,000 because that's what it was settled for. Putting it on 40,000, well, I guess it's maybe not material, but certainly some more information. Client ended a union strike with an agreement on February 15th. Okay. Normal business things are not considered to be subsequent event type 2 or even type 1. And if you have a union, they're going to be on strike every now and then. It's just the way it is. This is not a subsequent event. Oops. Yep. Yep. Very good. Okay, client introduced a new product that could revolutionize the industry on February 20th, 2022. Actually, this would be C. Companies introduce new products and some of them are big, some are small, whatever it is. And quite honestly, if they do release something that's going to revolutionize the industry will know about it and value it, whatever it's worth. But introducing a new product, having a union strike, these are not generally things that are going to change overall the financial statements. Okay. The date of the audit report. Go back to my thing here. Oh, it's kind of a mess now. I'm going to do it over. Okay, 12/31. Okay. Between the year end and the day of field work, you are actively looking for it. The last day of field work, this is going to be the date of the audit report. Is the last day of field work. So this audit would be dated 2/7. Now, during this time, up until here, what are you responsible for as far as subsequent events? During this period, you have to be actively looking for subsequent events. Now, this is kind of the funny area in here. You haven't issued the report, but the date on the audit report is 2/7. During this period of time, you are only required to look passively. Please go passively. So anything that comes to your attention, you're not actively looking during this period, but anything that comes to your attention, you will take a look at. So you're actively looking up until the date of the audit report, which is the last date of field work. This kind of limbo time between, and so, in here, you're forming your opinion, people are reviewing the audit and all that kind of stuff. And so you're going to issue a report a week later, say. During that time, anything that comes up, you're passively looking for it. Let's see here. I had a I had a friend that they finished an audit, and they're literally delivering the audit report to the client. They're in the car, and the manager, I guess, was in the back seat reading the paper, and he said, "Turn around, we got to go back to the office." And their client had merged, and they read it in the newspaper. One thing about mergers, a lot of times they're very quiet, hush hush, but the auditors didn't know about it, and they had merged with another company, so they had to go back to the office and redo the report because, again, passively, reading the newspaper on the way to dropping off the report, they found that they had done a merger. Okay. So date of the audit report. This is the last day of field work. It's the last day that the auditors are required that they're required to look for subsequent, all there. So is the last day of field work. Last day, the auditors are required to actively look for subsequent events. So after that date, they don't need to look for them anymore. They will passively look for them up until the release date. Passively, again, I think it comes to, if it comes to their attention. Okay. Client is a year-end, blah, 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 12/31, report, date on the audit report is February 24th, so it's the last day of field work. And the release date was on March 1st. On February 2nd, the client reached a settlement with a large investor for a material amount. The settlement qualifies as a type 2 event. Okay, so which of these is the right one? I didn't, I didn't ask a question, actually. Which one of these indicates what the auditor's responsibility is? So last day of fieldwork was the 24th. On the 28th, they reached a settlement with a large investor, and this qualifies as a type 2 subsequent event. Okay, this is actually going to be passive. The idea of the audit report is the 24th. Now, they haven't released it, until here, but they are required to look for that passively, because it is after the last day of field work. Now, it is true, they aren't off the hook completely. They're supposed to be passively looking for it. Okay. March 2022, the client's only warehouse was destroyed by fire. The warehouse qualifies as a type 2 subsequent event. What is the auditor's responsibility to that? This one's gonna be, this is a little bit confusing. This is gonna be the last one here. Man, am I making a mess out of this? All right, yeah. They actually have no responsibility to report on this. It's after the issue date. Let's steal this. What's wrong with my mouse? You know what? I did get a new mouse. I wonder if this new mouse is. Yeah, so this is March 8th. This is after the date. Now, if it is released subsequent to it, you'll put it in there. But generally, you're not going to change your audit report, the issue date of the March 1st. This happened a week later. And two, also things happen in companies all the time. And if you don't stop at some point, you know, you're never going to issue it, get the report out. So there's a practical thing that, you know, you got to get the report out with whatever information you have. All right, I think I'll cover dual dating just because it relates to what we just talked about, and then we'll call it a night. Okay, dual dating. There's a problem if you have something like this February 28th and February 24th. And here's the problem. You know, so let's say you do find something in the middle here. Yeah, you find something on the 10th. Oops. Okay, well, what are you going to do? You can put it in the audit report, but notice it's going to be after the year end. So you have a choice. You can either extend your audit report field work to the 10th. That means you have to go back and do testing between the 7th and the 10th. Or you can do what they call dual dating. You could put both these down, say 2/7 is the issue report, except for event X, which would be on 2/10. So let's see what that would look like on our thing here. So I'm just going to use this as the example. Dual dating. So the daily audit report will remain unchanged. For instance, in the example we have up here, this would be 2/24. But any subsequent events will be listed with a separate date. For example, in this one, it'd be 2/28. So they call this dual dating. Now, it could actually be more. I've seen, that's not me. I've seen audit reports that have had 5 or 6 dates on them. You know, because you get a company that's big and active, and sometimes things just happen. And so, they'll have, I've seen at least 5 or 6 dates for different items on for the audit report. So it is fairly common. We call it dual dating, although it could be more than dual. It could be, triple, quadruple, whatever, dating. Okay. Well, let's go back here. I am going to send out the Chapter 7 exam. It will be due on 12/9. So you'll be getting that within, I don't know, 10, 15 minutes. Any questions? Okay, and we'll pick up the we'll pick up the other one, the 16, 17 handout next week. Okay. Oh, have a good evening.